Hi friends, once again back to my video. In this video we are going to discuss about moving averages, what are the types of moving averages and what is moving average and how we can trade with moving averages, what are the trading strategy we can adopt. So here we are mainly concentrating on the practical side, as I mentioned in all earlier in my all videos, that we are looking only from the practical side of all these moving averages. So if you like my video and if you have not yet subscribed my video on the channel, please subscribe. Now we can look what is moving averages. There are two things mainly we have to just highlighting here. Moving averages are calculated based on the past prices. That suppose if you wanted to plot for 10 days moving averages, the 10 days price will take, closing prices will take divided by 10 days. That the way we are calculating moving averages. So based on the past price. Second one is, it is a lagging indicator. Why it is calling as a lagging indicator means it will not give immediate any signal that the prices are going upside or going downside. So that kind of immediate action or immediate signal or immediate warning you will not get from these moving averages. Secondly, it will always confirm you after a trend taken place. So once the trend is over, that time only you will be knowing that, or the trend has taken place, that time only it will be showing and indicating that, it will be indicating you that that trend has taken place. So we can look into one chart and how it is. I will show you that. This is gold chart. So in this chart you can see the prices are moving. So here the prices are moving below and upside actually. So what the basic thing is that it will not give you immediate signal that if the prices are moved here, this time only you will get the signal that the moving averages will be giving you a signal that prices are going down or the downtrend is started. When the prices are upside from here or this level, from this level might be you are getting a upside trend, that the indication from moving average that the prices are going upside. Secondly, you can see that the prices will move first. Here moving averages is a lagging indicator, means the prices will move first and it will be follow, the moving average will follow that only, it will be far behind this price action. So the price will move, so you will not get immediate reaction or immediate action. You can't take any immediate action from with the use of these moving averages. And third one, you can see that it will reduce the noise. Why it is calling why it is telling like that? Because suppose you have a long-term view that this gold will go from this level, that is 1465 to 1733, then your main view, your long-term view, strategic view is that it is the gold price will move up. So in between lot of other noises, like lot of sometimes the knee-jerk reaction or some selling may happen, some profit booking may happen. If you are following only the moving average, or if you are looking the moving average, then that kind of noise or that kind of selling or profit booking or small actions will not bother you at all, because you are knowing the trend. Actually this trend, moving average, is also showing an uptrend, so you can stick upon your trend and you can continue with that actually. So this will reduce the noise of this kind of unnecessary actions, and you can carry on with your, you can continue with your position with the trend what you are expecting. Okay, moving averages, what is going to give you initially, or it will highlight, these are the main points. One is it will identify the trends, what kind of trend is going on, whether it is uptrend, downtrend, and price, location, and support and resistance. Secondly, it will confirm the reversals. So we can check one chart how it is moving. This is one chart. Here it is showing the price movement actually, and a moving average with the moving average. So in this moving average, it is showing a downtrend because the moving average is moving to downside, downward line. And in here it is showing uptrend because the moving average is showing an up movement. So we can see how we can identify this moving average is showing a down movement, or it is moving to downside. That's why we are calling it as downtrend, and it is going upside, that is uptrend. Another thing is that if the price location, we have to see where the prices are trading. If the prices are trading below this line or below this moving average, it is a downtrend, it's showing a downtrend. Where the prices are moving upside of this line, that is showing as an uptrend. So this is called uptrend. Next, we can see how the reversals are confirmed. If the prices are trading above this price, above this moving average, that is a up, that is that is trading an uptrend. But when the prices are started crossing over, prices crossed moving averages and trading below this moving average, then the reversal happened here, trend reversal happened. It was trading in an upside, but suddenly the prices were crossed the moving average and started trading below this moving averages. So it is showing a downtrend, so or it is showing a trend reversal. Now from moving average, what are the things we can understand, we can identify is that one is whether the instrument trend is up or whether the instrument trend is down. Third one is we can identify that whether the instrument is in the same trend is continuing, it is continuing the same trend or the reversals happen. That we have seen here, it is continuing in the same trend or the reversal happen here. That now next topic is we can check what are the types of moving averages are there. There are three types of moving averages are there. One is simple moving average, second weighted moving average, and exponential moving average. What is simple, weighted, and exponential? Simple means it is giving equal weight to all the days or the period. Suppose if you wanted to calculate a moving average of 10 days, the 10 days, it will each 10 days data will give the price, closing price of each 10 days will give the equal importance or equal weight in this simple moving average. So it is calculated very easily, like 10 days closing price will take divided by the 10 days, it will be giving you the simple moving averages. There are some issues with the moving averages. Simple moving average responds slower to rapid price changes. That is one there. It will not be close to exactly with the prices. That is one issue which we are seeing. Now we can look what is exponential moving average and weighted moving average. How it is this? What kind of differences? So the main difference from simple moving average and is that it gives more weightage to the latest data. That means more weight and significant the most recent price data, whereas in the simple moving average it gives equal weightage to all the data. Here the weightage is given to the recent data, so it will be, when you give a weightage to the recent data, it will always close to the price level or it will give you exact the price action. There is a chance is there. Secondly, respond faster to price action. It will always respond to the faster to the price action. Then we can see less weight to the old periods, so it will not give more weightage to the old period data. So this is again we are taking gold chart. Here we can see, we can use we can analyze with this moving averages. So we'll go to simple moving averages. We are taking the periods as 14. Okay, then we are taking exponential moving averages as 200. Then third one we are taking weighted moving averages, so we are taking that also 14. So these three moving averages we have taken here. So now we can analyze what are the things is. So here you can see which one is closer to the price. So weighted move, this is simple moving average, this color, this one is simple moving average, this simple moving average, and this is weighted moving average. So if you are looking at this chart itself, weighted moving averages are so close to the price than these simple moving averages. Here also you can see this simple moving average, weighted moving average is so close to the price, but whereas this is simple moving average, not that much close. So more close is this weighted moving average only. Secondly, how the trading call here, when the price, when weighted moving average the crossover is happening here, so you can see some kind of crossover. So what kind of crossover happened here is that when simple moving average crossed this exponential moving average crossed a simple moving average from the top, then you can say that is one kind of selling has happened here. Here you can see exponential moving average crossed a simple moving average, that time the selling has happened. And the reverse happened here when exponential moving average crossed simple moving average from bottom, from lower level to upside, that is a buy call is also. So that is also one other. So the trend reversal, you can see whenever the crossover happens, some trend reversal is happening here. So that is exponential, simple, and exponential moving average. You can see it is giving you a long-term view. Actually, suppose you are keeping as a exponential moving average, and you can see that it will always act as a support, big support. When the prices came to here and tried to break exponential movement but didn't succeed, Here also it came and touched the exponential moving average, tried to break but nothing. So it will give you a long-term direction that it's going upside. When the crossover happen below or downside, then you can see that this trend has reversed in this case. We have to look what are the time frames mainly commonly used actually in the market. So these are the time frames: 10 to 20 for short-term trends, 50 for medium term, and 200 from long-term trends. These are the main time frames which we are using. Now we can look what kind of trading strategy we can. So when the trading strategy with the moving average, okay, don't work on lower time frame, wide and sideways. These two things you have to always very careful. Don't work on lower time frame and sideways market. We can show you how it is work in the chart. So again, in this chart we are taking the time frame as 10 minutes or 10 minutes, and 10 minutes if you are trying to trade with this with moving averages, there will be a lot of noise you can see, and it will be always giving you a false message also. It will always giving you some kind of false message. Why it is calling is that when you are here, suppose you are here one crossover has happened, and in this crossover you will be thinking that this crossover is showing that it will be a down or selling will happen. But try to sell here again. This is again the crossover has happened to upside, so you think that it will be again going up. So but again here the crossover happened to downside, but nothing has happened. So in the small time frame, in the time frame it will be crucial for this weighted moving average actually. If you are taking the small time frame, shorter time frame, then that cases you that in that cases you will be getting lot of false calls actually, false breakouts or false calls. Suppose the price is crossed here, you will be thinking that selling is coming, and breakout is the selling is coming, but nothing has happened. Similarly, all these places, when you are taking this kind of shorter time frame, then there will be a problem for the calls actually. It may go long also, you may lose the money also, because in short term time frame moving averages crossover or that kind of things won't give you the exact idea about that. A lot of false signals you will get it from that. Secondly, if the market is moving sideways, suppose the market is moving in a sideways, like here you can see this. Suppose the market is in a sideways movement. Here nothing has happened like sideways actually, but still I'm trying to give you some idea. Market is in a range, or if it is trading in a range, it will give you something like when the crossover happen, you will think that immediately going down, but nothing has happened upside also. So the important thing you have to note that when it is in a sideways movement market, movement market, moving averages crossover or moving averages won't give you the exact signal of whether the prices are going up or prices reversal is happening or any kind of such calls. You can't go for with that. If you are trading with these kind of calls in the sideways market, you may end up in a losing money actually. So that's all about moving averages. So I hope it will definitely help you to understand what is moving average, how we can trade with moving averages, what are the strategy we can adopt it, all these things. Okay, if you like my video, thank you guys for watching. If you like my video, please subscribe and please like. Thank you so much.